This is your host, Ray Ross, and Everything Money. This is episode 4. Today, we will be talking about Fundrise. That's right, Fundrise. Now, if you don't know anything about Fundrise, Fundrise is a Washington, D.C. based financial technology startup company that operates in an online investment platform. Fundrise has been labeled as the first company to successfully crowdfund investment into the real estate market. Now, Fundrise is a REIT, so let's quickly go over what a REIT is. This definition is coming from www.reit.com. A REIT is a company that owns, operates, or finances income-producing real estate, modeled after mutual funds. REITs provide all investors a chance to own valuable real estate, present the opportunity to access dividend-based income and total returns. It helps communities grow, thrive, and revitalize. Now, you're basically saying, what is a REIT? I heard you read the definition, but what is truly a REIT? So I have another definition, and this definition is coming from www.investopedia.com. And the question they pose is, what is a real estate investment trust? That is the definition of the acronym. And also they give some history of how REITs actually got started. REITs were established by Congress in 1960 as an amendment to the Cigar Excise Tax Extension of 1960. They allowed individual investors to buy shares in commercial real estate portfolios that receive income from a variety of properties, including apartment complexes, data centers, healthcare facilities, hotels, infrastructures, office buildings, retail centers, self-storage, timberland, and warehouses. Fundrise is a REIT and also another source of passive income. We've heard the terms passive income and residual income. Residual income is basically discretionary income left over after pretty much you've paid all your bills. Residual, what's left over, right? What's left after I did whatever I did with my money, residual income. Passive income is money earned with minimum activity through a variety of ventures which require little daily effort or upkeep on the individual's part. The initial downtime you put into passive income can be as involved as starting a blog or as simple as logging into a robo-advisor platform and investing $100. Now, Episode 3 of Everything Money, we went over robo-investment advisories, and you can look into that. And that definition from passive income came from www.goodfinancialsense.com. Now, my own definition of passive income is money is making you money and you're doing absolutely nothing. Like right now, as we're doing this podcast, Ross World, aka Ray Ross, is making money off of passive income because I invest in Fundrise. I also do robo investment advisories through their particular platforms. I probably have at least 3 of them that I'm investing right now. That's diversification and also that's passive income. Fundrise is offering passive investment, which in return gives you passive income. Because passive investment, unlike owning your own commercial real estate outright, it's an investment to properties they have and you're receiving money back from that. Now, according to InvestorJunkie.com, in 2015, Fundrise shook the crowdfunding space with the introduction of its first eREIT. An eREIT is short for Electronic Real Estate Investment Trust. It's an invention by Fundrise to make investing in commercial real estate accessible to the masses. eREITs are similar to investing in an ETF or mutual fund. We're going to move on and talk about getting started with Fundrise because you heard about this great opportunity. You might have heard about their return rates and their percentages and amount of money you can receive. So let's get into how to get started. So to get started with Fundrise, you need to make an initial investment of only $500. Now, if $500 is steep for you, then this is probably not a good investment, depending on your financial portfolio. What do you have going on in your finances to prevent you to put $500 to $1,000 on this investment? So after you quickly go over your budget and you see if you have it or if you don't have it, but on the chances you do have it, I advise that Fundrise could be another investment that could diversify your portfolio even more. Now, with this, that $500 that you invest in the service starter portfolio, it's a diversified mix of eREITS and eFunds with underlying real estate projects located throughout the U.S. You'll receive returns via quarterly dividends as well as appreciation in the value of your shares. With an investment of $1,000, you'll be upgraded to a core portfolio. Now, the 3 core portfolios are as listed. Supplemental income, that is a steady income stream with a focus on dividends. Balanced investing, a more diversified portfolio designed for greater wealth building. Long-term growth, designed for potentially superior returns over the long term. If you are unsure which one is right for you, Fundrise offers a 3-step questionnaire that can help determine how you should invest. So that would steer you in the right direction if you don't know the avenue in which you want to take. Now, when you sign up for Fundrise, you'll invest either in the low minimum starter portfolio, which I have, or in one of the 3 core portfolio plans. Whichever one you pick, your money will be invested and allocated in assortments of eREITs and eFunds consisting of private real estate assets located across the U.S. Now, Fundrise will tailor your specific allocations based on your personal investment needs. Although your own results will vary according to your personal plan, you can expect to receive payouts in 2 ways. And that's the most important thing. You're wondering, how am I getting paid, right? Like, we'll get into how much you'll be getting paid because that's going to vary as well. Because remember, this is an investment. The first way is quarterly dividend distributions. And now that is dependent on how the market is moving and how real estate is doing in the platform that Fundrise uses. Number 2, appreciation and asset value. Now, appreciating asset value at the end of the asset's investment term. Keep in mind, though, that Fundrise portfolios are meant to be long-term. So here's something to remember, guys. Savings are for short-term and emergencies. Yes, saving is for short-term and emergencies. I want you to think about it. Investments are for long-term. If you look at any sort of investment, right, anything quick is usually 9 times out of 10 very volatile, and you can make a lot of money and you can lose a lot of money. But when you deal with steady ETFs, index funds, and some low interest mutual fund accounts, it's for long term. It's for building money over time, building that compound interest that nobody understands, how money on top of money is making money exponentially. Yes, compound interest. It even had Albert Einstein confused on how it does. He was like, it's the most wonderful thing in the universe. I don't know how he actually said it, but I'm pretty sure he said it something like that. As we went over, we have 2 sorts of plans, and the second plan has 3 things under it, right? So the first one is your $500 for your starter plan, and then your second one is your $1,000 for your core portfolio, which comes with those 3 terms I spoke of before, and that was supplemental income, balanced investing, and long-term growth. And supplemental income focuses on dividends. Balanced investing is a more diversified portfolio designed for greater wealth building. And long-term growth is designed for potentially superior returns over the long term. Of course, once I get my account to $1,000, I'm going to long-term growth because I'm going to keep it in there at least 20 years because I want my money to make money. Now, one of the things that could counteract you making good money and great returns are account fees. So you're trying to figure out what is a good investment and how much I'm going to pay to invest with this particular company. So let's go over some account fees with Fundrise. Fundrise charges an annual asset management fee of 0.85%. In addition to a 0.15% advisory fee, these add up to 1% annual fees, guys, just 1%. Now, this is what I read going through their website, talking to some people about their advisory fee as well as their management fee. Is only 1%, which is really, really low, according to the history of Fundrise and the returns that I've seen. The company can also charge miscellaneous fees that can add up to 2%. In total, you can expect to pay as much as 3% on fees. Now, that has not been my experience. This is just something that in the fine print, in the writing, that they can do, but I haven't seen that yet. So hopefully it stays at 1%, because as far as I know, Fundrise have been doing a lot of great things. Now, the offering types of these accounts are debt, equity, and preferred equity. And again, we went over the property types: commercial, residential, single family, and those included single family homes as well as apartments. Now, those are the fees that you can expect from Fundrise. And now let's go over the features that Fundrise has to offer. They have a self-directed IRA, individual retirement account, a self-directed IRA. Now you can invest in Fundrise with pre-tax dollars and use for retirement planning. And note that this particular self-directed IRA can only be used for eREIT offerings, just to put that as a note so you know what you're getting yourself into. They also have goal-based investing. Okay, now via the Fundrise 2.0 platform, and that's the name that they give it, invest in real estate based upon your goals rather than the types of investment or location. So you have some options here. You can go in locations for your investments, or you can invest based upon your own personal goals. Good options, none bad in my opinion. eREIT, a non-traded REIT that invests in multiple commercial real estates, compared to traditional REITs, cuts out the middleman, saving you on commissions. So commissions is a big word saying we're going to pay the middle guy. So when you eliminate the middle guy, you alleviate his or her commissions, thus saving you money on fees. Again, we're doing all these robo-advisors and online platforms, whether it be for real estate or stocks, to alleviate fees, to alleviate the middleman, to alleviate commissions. You also have another feature called eFund. This is a private fund that invests in multiple commercial real estate properties. Unlike Fundrise eREITs, focuses on growth rather than income. And last but not least, you have the Fundrise IPO. The Fundrise IPO. Fundrise is getting ready to sell shares in the company itself via an internet public offering, if you didn't know what IPO meant. To be eligible for this investment, you must have at least $1,000 in your Fundrise account and have selected one of the advanced plans. You can invest up to 25% of your total account balance in this offering. So be advised, a lot of these features are really new with Fundrise. Some of this is late as last year and early as this year. So just look out for these things and see which one is good for you, or just go with the starter plan like I did that only costs you $500. Now, as far as promotions are concerned, currently Fundrise is not offering any promotions. After going all over the fees and how to set up your account and what to expect, you're probably asking yourself, well, how safe is Fundrise in investing? So let's get into safety in investing. Now, very few investments can be considered truly safe, right? That is with a guaranteed return. None of them will give you a guaranteed return. However, less liquid real estate investments tend to give better protection from downturns in the broader market than securities such as stocks and mutual funds. Remember, this investing is nothing guaranteed, but with real estate, you're actually investing in hard shell buildings, apartments, and houses. So you're less likely to lose money, but there is no guarantee. And speaking about guarantees, Fundrise has a 90-day guarantee, right? 90-day guarantee. Unheard of it in the investment industry. If at any time during your first 90 days as an investor, you're not satisfied, Fundrise will buy your investment back at the original investment amount. This offer is subject to certain limitations, and those are in the fine print that we're going to leave for you guys to read. But in my own personal opinion, when we talk about the safety, just to caveat on that a little bit, Fundrise portfolios of eREITs and eFunds are about as safe as you can find in a real estate space. So that gives me some sort of reassurance in my investments. So let's go about the performance. How is Fundrise actually performing? Now, Fundrise recently revealed stats on how its REITs have performed. And we're going to talk about some fiscal years here. In fiscal year 2014, 2015, 2016, and 2017, the returns are as listed: 12.25%, 12.42%, 8.76%, and 11.44% respectively on those numbers. So I did 2014, 12.25%, 2015, 12.42%, 2016, 8.76%, and 2017, 11.44%. Now, those are the average annualized bases. Now, obviously, keep in mind that previous performances does not indicate future returns, okay? You can never base future profit on past returns, on past results. So let's keep that in mind. And by the way, those are some great rates. Anything over 7% in my book that my money is making money is something that I want to be a part of. I want all of my investment platforms to make at least 7% because on average, since the stock market was first established, that has been the average return. So I want to stay at 7% or above. And above is always better, but at least 7%. Now, there's a slight complication when you want to cash out those gains, because when you're making good money, sometimes you want to take from this good money because maybe you want to put money down on the house. Maybe you have a painstaking bill that just been bothering you, and you say, you know what, I'm working against my better interest. Here I am investing money, but I have debt, and I need to get rid of my debt to truly build wealth, because you can't build wealth if you have debt, because you owe someone money. You owe an entity or organization or corporation money. In order to really build wealth, your income is your greatest tool. In order to free up your income, you have to pay off your debt. I didn't say pay down, pay off your debt. Am I debt free? No, I am paying off my debt. Paying off my debt. That is the key term, paying off my debt. And Fundrise, again, is another great investment to put into your retirement portfolio, because here we invest for retirement. We don't save for retirement, right? Because people say, oh, you need to save for your retirement. And that's kind of the term that people use, but the correct term is invest for your retirement, because when you do a 401k, is an investment. When you do a Roth or traditional IRA, is an investment. So understand what those terminologies mean. Now, when I mean there's a slight complication when you're trying to cash out those gains, and that's because that the money you invest is put into particular properties. Now, you wouldn't be able to receive money from a deal until the physical property is sold. To rectify this matter, Fundrise now allows investors to cash out of deals during specific quarterly periods. So you can get a trade during 4 windows per year without having to wait for a sale. Basically, what they're saying is your money is invested into real estate, actual houses, actual apartments, actual condos, etc. Now, that money is in that property, right? It's a part of the equity building program to receive dividends when the equity rises and you get a kickback on those returns. Now, in order to liquidate that amount, they will have to sell the property. But what they did, they're allowing people to get that money back through other means, because they need to appropriate their funds, balance their budget to see how much they can pay people out. So they allow during certain terms where you can actually file to get your returns out. Now, how much you want to get out, that's solely on you. But I just want you to understand the model that they have going, because at one point, there was really no way to get your money out. You'll see your money growing, but there was no way to get it out until the property has been sold. But maybe you need it before then. So they created these trade windows 4 per year in order for you to get your money out. Now, during this podcast, we talked about diversification. And if you don't have your money in real estate, I would say you might want to look into Fundrise as getting money into real estate, because it would diversify your program like nothing else that you may be investing in. Maybe you have a few index funds. Maybe you have a few ETFs. Maybe you have a 401k. Maybe you have a 403b. Maybe you have a Roth IRA. The more you diversify, the more that you are protected from a market crash and also from inflation. Now, during a market crash, a few things in the market actually bottoms out. And we all hope and pray that doesn't happen. But a market crash, and I'm not trying to be the bearer of bad news, it's going to eventually happen again, right? It usually happens on a 10-year cycle, but right now we're past that 10-year cycle and nobody really knows. The only thing I'm saying is Don't sell any of your investment because the stock market, on average, has always bounced back and doubled itself. Always. Now, you can look into it. Now, a little bit of history about the stock market. America wasn't the first one considered the first stock market. It was actually Belgium back in 1531. But nonetheless, according to our stock market, it always comes back double. Like the NASDAQ, the Dow, all of those things are worth more than they were before, right? Because money keeps growing. And we talk about inflation. Let's talk about inflation just a little bit. Now, inflation is basically things get more expensive yearly. Materials that make buildings, wood, you name it. Everything becomes more expensive, even food. Inflation rises every single year. Every single year, inflation rises. It doesn't matter if it's 1.8 or 2.1. And the reason why those numbers are important is because that is the usual rate that inflation actually rises. But nonetheless, it rises 1.8 to 2.1. The average, 2.0. Let's call it 2.0. So I always talk about high yield savings. And you can look at my first podcast. I talk about high yield savings account, and all of those are 2.40 and above, beating inflation by 0.3% on most terms. But market crash and inflation. If the market crashes, keep your money where it is and look at it bounce back. And if the market crashes, you just want to keep your money in there and see it bounce back over time. And granted, I always use this particular example because I didn't have any money in Citi, right? CITI, Citibank. And at the time of the market crash around 2008, 2009, a buddy of mine say, hey, you should try to invest some of your money in banks because they're going through a bailout and the government is not going to allow them to fail. So I said, okay, I bought 250 to 300 stocks of Citi. And I waited, and I bought them $4 per share. For that stock of Citi, I bought them $4 per share. And as time went, within a year's time frame, it went from $4 to $3 to $2. And I want to say, if I can remember correctly, down to $1. And I panicked. That's right. I panicked that the stock was going to bottom out, and I sold them all. Today, that stock is worth over $65 a share. So I want you to do the math here. So if you have a stock that is worth now $65 a share, but you bought it at $4 a share and you had 300 of them. So 300 shares times 65 is $19,500. Now, 300 shares times $4 is $1,200. So a little subtraction here. $19,500 minus the amount that you paid for it, which was $1,200, equals a profit of $18,300. Now, if someone would have told you, you give me $1,200, and in 10 years, I'll give you back $18,000, why wouldn't you do it? Why wouldn't you do it? That is a great return. So not to get off topic here, guys, that's just my experience of investing, that I panicked and I sold my stock and I literally lost money because I bought it at $4 and sold it at $1, meaning I lost $3 per share. I didn't even break even. Now, to just caveat on how to receive your funds from Fundrise, because if I wasn't clear before, I'll try to make this as plain and simple, because at the end of the day, you can invest all your money, but at some point, you want some of your money back. Now, in order to redeem your shares from your Fundrise portfolio, you need to first submit a redemption request. You can do this simply from your account settings on the site. After a 60-day waiting period, you may obtain liquidity on a monthly basis. Keep in mind, however, that your redemption value may be subject to a penalty of up to 3%. You can reference all of this information at www.fundrise.com. And you can also email them at contact@fundrise.com. That's contact@fundrise.com. Shoot them out an email, and if any questions you have, within 48 to 72 hours, they should be able to respond to your question. All right, everyone, that's all I have in this segment in Everything Money. Tune in next week. We will be discussing index and ETF funds. So tune into next week. Get the information to make your life better than it already is. This is Everything Money, where we break down complicated financial information and we give it to the people financially free in a common sense way. This is your host, Ross World, aka Ray Ross. I'm out.